Hello, and welcome to the topic where we highlight community college, Houston Community College, I should say, our students, our programs, and our reach into the community. I'm Daniel Scholl, one of the financial coaches here at HCC, and we're here every Thursday afternoon when HCC is in session live at 2 p.m. on Facebook and YouTube. You can follow us on social media as Houston Community College District, and you can watch us on HCC TV via your local cable provider. On this episode of our continuing series, The Topic, Financial Focus, we're looking at investing in times of uncertainty. And I'm joined today by an old friend of mine, Christian Sellier, a retired investment advisor. Christian, welcome in.
Hi, how are you?
Great. How are you doing today?
Doing very well.
Good. Well, thank you for joining us. I think I'm hearing from a lot of people. A lot of people have questions right now
Yeah.
about what's going on in the markets and what they should be doing. And I guess I want to start kind of just at the beginning. What are kind of just basic strategies that everybody should know about investing?
Yeah, so the main idea behind investing is not putting all your eggs in one basket, right? So the fancy word for that is diversification. So you want to pick a basket of investments that, if one company goes bankrupt or one bond that doesn't get paid back, you don't lose all of your money. So that's the whole idea. And you can do that at all stages of investing, from when you're starting out. You're putting out a little bit of money into your 401k or your 403b, or maybe you're doing it on your own, to when you have a lot of assets. You've accumulated them. This is diversifying, hits you at every stage of your investment life.
Okay. Now, I feel like something I should get, a disclaimer here. You are not, and I am not, and no one here at HCC TV is dispensing individual investment advice. We were just talking about basic concepts, just ideas, right?
Yeah, it's interesting because everyone's financial picture is pretty unique. Yours, mine, if someone's starting out. So if what we're talking about are the big, bold, generic stripes. And really, we encourage you to seek out individual investment advice, especially if you're at a juncture in your life. You're moving jobs, you have to roll over a 401k, maybe you've inherited some money, maybe you've just started your new job and you're starting to invest into your 401k, and you want to figure out what are the allocations. It really is worth your time to seek out advice individually tailored to your own needs. So yes, today we're kind of hitting the broad strokes.
Yeah, and we'll talk a little bit later about how do you go about getting some of that advice. But I often tell people, look, you really shouldn't diagnose yourself with the doctor on television
Yeah.
because he's not talking to you, right? He's not giving you an individual diagnosis, and it's kind of the same thing with investing. Like you said, everybody needs their own plan, their own diagnostics, right? I mean, we can understand general concepts, and that's kind of what we're talking about here today. Um, Talk to me a little bit about, like, okay, we're in these uncertain times, they say, with the market, but we go through this every once in a while. What causes market uncertainty?
Well, the variety of reasons. Generally, market uncertainty, there's always some level of market uncertainty. Nobody has a crystal ball. We don't know what the future is going to bring. So, at any given moment in the market, there is some level of uncertainty. If we're talking about stocks in particular, when you're looking at, it's interesting to look at investing through the risks that you're trying to mitigate. So, on the stock side, you're looking at um, volatility risk, right? Like so do most participants in the market believe things are getting better, or do they believe things are getting worse? Or worst of all, do they not know? And not knowing is the uncertainty. There was a famous, what was it, Twain, who said or said the certainty of misery is better than the uncertainty of misery. The markets do not like, if they understand things are going to get worse, they do better than if they don't know at all.
Yeah.
So on the bond market, you have uncertainty due to what's going to happen to interest rates, right? You have interest rate risk, and then general economic conditions. Are Are companies going to go bankrupt? Is the business cycle going to be, are we going to be in a recession? Are we going to be, in a bull market? Is it going to be growth? These are the things that sort of can inject or take out uncertainty from the market. So
Okay.
right now we're we're in a situation where both of those things are happening at the same time. We're not sure what the economic cycle is going to look like here in the next 6 to 12 months. And we also have a fair amount of interest rate risk. If you're holding a bond right now, we don't know if rates are going to fall or they're going to stay the same. Obviously, if there's a recession, you kind of imagine that rates will come down, but that is not what the Fed has said. So, we're now 2 meetings into a condition where there's a lot in the air. There's a lot up in the air.
Well, we talked about basic strategies to start out. Are there strategies for these times of uncertainty?
Yeah, there's several strategies. I mean, you can dollar cost average in. So if you think of somebody who's starting out and they're just now putting money into the 401k, and their time horizon, the time when they're going to need this money is more than 10 or 20 years out. That dollar cost averaging, adding a little bit into a mutual fund or an ETF or a selection in the 401k or 403b every month kind of averages out those ups and downs, right? Sometimes you can buy and it's going to be on the high side, and sometimes you'll buy and they'll be on the low side. And this is generally called long strategy. You diversify by the times in which you purchase. So you may go through a bear market, which if you're thinking about somebody who's got a 20-year or more horizon, that may not be a terrible thing. You want to be able to buy at better prices than you would otherwise. As the market goes up, obviously your assets improve, but things become more expensive. So, it depends on your perspective. But dollar cost averages helps you either way. So if you're planning your retirement and you have some expenses coming up in a year or two, it's a good thing to start taking out in sort of like on a quarterly basis or something like that. You can average out of the market as well, but as you need those incomes.
Okay. And we've got just maybe about 30 seconds here real quick. Do you ever advise people just, hey, in uncertain times, get out of the market, or is it better just to ride it out?
For most people, most of the time, it's if you're in a well-diversified, low-cost mutual fund and you don't have or ETF or an investment vehicle that is well-diversified and has low cost, it generally works out better to stay in. You can't time. The timing of the market is a fool's errand. But now if you need money, if you're in a situation in your life where you need money within 12 months, you should be liquid. So yes, in that situation, I would say get out. You don't want to ride the volatility knowing that you need that money within the next 12 months for sure.
Well, you've given us a lot to think about here as we kind of put down a baseline. We're going to take a quick break. When we come back, we're going to take a little bit deeper dive into the different kinds of investments.
Learning looks like this, and it also looks like...
I'm not just studying agriculture. I'm learning how to grow for the future.
I came back to grow my skills, even after I graduated.
I'm not just studying AI, I'm designing solutions to make the world a better place for us all.
And if I can't make it in person, I take my classes online.
So, where do you start?
If I could be you, and you could be me for just 1 hour. Walk a mile in my shoes. Walk a mile in my shoes.
Welcome back to the topic. For our financial focus today, we're looking at investing with retired investment advisor, Christian Sellier. Christian, before the break, we were kind of talking about strategies, and you had mentioned, retirement, and that's usually how most people invest, right? For most Americans, their investments are their retirement investments. Can you talk about what that looks like versus other types of investing?
Yeah, I think it's important. I know you and I discussed this about, what are most Americans have their house or their real estate that they live in, and their investments those are the two biggest assets. They're your 401k at work and your home. And your home generally is the bigger of those two for most Americans as it falls, on the bell curve. So when we're talking about investing assets, you generally look at equities, which we call stocks, and bonds, which are, their own world. I sent a couple of slides here. The first, I thought it'd be easier to think of it as the difference between stocks and bonds as what happens when things go badly, right? Let's go to the worst case scenario: a company goes bankrupt, or a municipality can't pay their bonds. So the creditor order for for bonds, for example, there are all these terms: senior debt, subordinated debt, preferred debt. Anyway, the bottom of that line is stockholders. So if you think of a company going bankrupt, bondholders get paid first, stockholders get paid last. That's the main point of this slide. And the idea is, people will talk to you, they'll tell you that bonds and stocks are sort of behaving equally, and they can from time to time. But a well-diversified portfolio will own both. And the reason is that which we just described, which is bonds are, generally speaking, more secure. Standard & Poor's puts out a report every year on the corporate defaults. And they've done this forever. The last one, they came up in 24, and it goes all the way back to 1981. And you may have heard that recently the US lost a credit rating. We went from AAA to AA+. And I wanted to show you this slide and I highlighted 4 numbers, because when we look at bonds, credit ratings are very important. So investment grade bonds are anything graded BBB or above. And if you look at that number on this chart, BBB bonds over 10 years, there's a 3.8% default rate. So 3.8% of those companies or municipalities, whatever, that are rated BBB have gone bankrupt. If you look at CCCs for that same period of time, 55% of those companies have gone bankrupt. So it's a pretty stark difference between the lowest of the investment grade bonds to the lowest of the junk bonds, basically. Now, you get paid more to hold the junk bonds. Those interest rates are higher, but more risk, more return, right?
Right.
If you go about 15 years, the numbers are a little bit worse. And on the BBBs, it's 5.34% compared to, say, 57%. So anyway, I thought those two would give you a good idea.
So what I hear you saying is, equities, stocks, right? That's, when things are going good, you can kind of hedge with bonds. But when you are investing in bonds, pay attention to the rating. You want,
Yes.
if you're getting into bonds because it's a little bit safer, you want to make sure that you're going into safe bonds.
That's correct. Yeah, you want to at the very least be a BBB or above, which are investment grade bonds. That's for most of us.
Okay.
If you're an institution, or you're a more sophisticated investor, you can go into the high yield offerings depending on what your appetite for risk is. But companies that have stock also have bonds, and it's a good thing to look at those credit ratings.
Yeah.
Because there is a synchronicity between those two things.
And I'm going to ask you a question in a second, but just real briefly, just for people out there. So a stock, basically, when you own stock, you actually own ownership in that company.
That's right.
When you own a bond, you've actually lent that company money.
That's right.
And you're a
totally
creditor.
That's
At its
correct.
most basic level, that's the difference between the two. Hey, quick question for you. What's more important when you're making your financial decisions? Your personal information, your personal situation, like your age, your goals, income, debt to income ratio, all that, or market conditions? Which one's more important, or is it a little bit of both?
No, the first is way more important. Like, I think your own personal picture is the most important thing, because it doesn't matter what the market conditions are. If you're 6 months from needing money, that's a different position than you're 25 years from needing money. That's even risk tolerance, it doesn't matter. All of that changes. So yeah, your own personal risk tolerance, your own personal stage in life, your own personal goals are really what drives. I think that's the sort of don't push the that cart in front of the horse thing. That's the most important thing.
Well, and then that makes sense, right? As going back to everyone kind of needs their own prescription.
That's right.
Okay, so stocks and bonds, we'll talk about mutual funds in the next segment. But stocks and bonds, I think when people think of investing, that's mostly what they think of. But there's other stuff out there, right? Real estate. I know people want to talk about crypto a lot right now.
That's right.
Passive income. What are some other investments that the average investor maybe should or be taking a look at? Precious metals.
Yeah, there's precious. I mean, right now, gold is done very well for people that bought it last year, or a year, or even 2 years ago. It's done incredibly well as volatility has increased in the market. Gold prices have gone through the roof. Yeah, there's precious metals. There's gold, silver, platinum. These things trade in Chicago on those boards. There's real estate. There's real estate investment trust. There's even in the bond side. There's investment side and investment grade. There's high yield. There's also senior collateralized debt. There's a variety of alternative investments, and that's where I think a broker really helps you navigate that. Somebody or a financial advisor that can meet with you and see what your goals are and figure out a good mix for you to be diversified.
Yeah. And I often tell people who ask me this question, and I'm kind of curious on your thing, and then we'll take a quick break here. But if you don't understand the investment, I tell people don't invest in it. If your broker is throwing a lot of stuff at you, you don't understand it. Would you agree with that?
Yeah, I used to say in my practice, if you couldn't walk out of my office and explain it to your grandson, then you really shouldn't be in it. You really have to be able to explain. You have to be able to understand what you're investing in. I think that's sage advice. I think it'll treat you well.
For sure.
Yeah.
So we are going to take a quick break. When we return, we're going to talk about how you can look for reliable advice in your investment journey.
Learning looks like this, and it also looks like
I'm not just studying agriculture. I'm learning how to grow for the future.
I came back to grow my skills even after I graduated.
I'm not just studying AI, I'm designing solutions to make the world a better place for us all.
And if I can't make it in person, I take my classes online.
So, where do you start?
It has always started with the call to serve, fighting and winning for our nation. But Marines are never really finished. They serve in communities across our country. This is Semper Fidelis, always faithful, always Marine.
Things could be stranger, but I don't know how. I'm going through changes, through all of the strangeness. I'm going through changes now.
Welcome back to the topic. For our financial focus today, we're looking at investing with our friend, retired investment advisor, Christian Sellier. All right, there's internet advice, there's books, there's magazines, there's radio, there's people in offices. Who can help you navigate this murky world out there?
Yeah, that's a very good question. And just in recent time, I know, Dan, you and I have been in the business for a long time. It wasn't always like this, but there have been new designations that help people figure it out. It's pretty simple. I would ask anyone who's looking for financial advice to look for a broker or advisor that is on your side of the table, not somebody who's representing a product and the way you do that is you look for a word, it's called a fiduciary. So you want to have a financial advisor or broker who's a fiduciary. That means they have a legal standard to recommend things to you that are in your best interest, not in the best interest of the firm or the institution that you're dealing with. Previously, there was a standard, it was called the suitable standard. And you'll run into people, and this doesn't mean there are many good people on all sides of the business, and I think you can run into people that have a suitable standard that are very, very good.
Yeah, no, I'll chime in there for a second. I would have people ask me, so, well, where do the good brokers work? Because they work everywhere. Where do the
That's
bad
right.
brokers work?
That's right.
Unfortunately, there's some bad brokers that work everywhere, right? It's not.
And I have to say, in my experience, most brokers really do want to help.
Oh, for
the
sure.
clients. I mean, one of the most amazing things about this career is that you get to meet people that do a variety of things for a living. It's so interesting. If you're in school right now and you think that you may want to get into financial services, it is a very rewarding career. It's, stressful and everything else, but you get to meet people that do a myriad of things for a living. And it's just really a fascinating, every day at work is different.
Yeah. And you do get to help people, right? And
Right.
like you said, you're right. I mean, you'll hear a story in the news from time to time, but most of the people in the industry that I met, they're trying to create win-win situations for all their clients, right?
That's right. That's right.
So, okay,
But lately, that term fiduciary is one that you should keep, file in the back of your head, because
I was going to ask. So, is that acceptable? Just walk in. Hey, I'm interviewing people to manage my money. What's your title? Are you a fiduciary? Is that okay?
Yeah, you can ask. Yeah, are you a fiduciary? And they will tell you or refer you to someone who is. And generally, if you walk these days, because that knowledge is now more well distributed, banks and institutions and brokerage houses have fiduciaries that will work with you. And that, I mean, I think that's a great advance in our business over the last 30 years. It's been great.
What about some of the other titles? People say, well, I'm a certified financial planner or I'm a chartered financial analyst.
Right. Yeah, I mean, all of those designations are great, and they're very specific. Certified financial planner is a pretty big one. And these are guys and girls that are working with institutions and larger larger investment groups, teacher retirement funds, and things like that require, it's like CPA, that you need that kind of designation. If you're an individual investor and you're at a company and they have a 401k, that company that provides the 401k may have an advisor that can help you select. They may have tools on websites that'll help you choose what the different funds are. Now many of those are fiduciaries. Many of those you can ask that question and they will be there. The next standard under that is suitable. So you do at the very minimum want that, which is somebody who will advise you to do something that is suitable for someone in your age bracket, risk tolerance, that kind of thing.
Okay.
I think where there's a lot of tension is where you have maybe insurance products that are they're sort of pushed onto people as investments.
Well,
which, some insurance products kind of blur that line.
Yeah.
Insurance is great. I think everyone should have it.
No, for sure.
Investments are great, but when you make those things, it can be a little tricky.
I'm a fan, and you know what? Maybe we'll have you back someday, and that could be a topic probably all onto its own. But I am a believer that I want to get banking products from banks. I want to get investment products from investing companies. And I want insurance from my insurance companies. And I think it's okay to keep those separate. Now we've been talking a lot about how to find a person to help you. Some people are going to do it on their own.
Yeah.
And I was wondering if you could talk to me a little bit about like self-directed funds, mutual fund, no-load mutual funds.
Yeah, again, I think this is the golden age for that kind of person. I mean, I think you have companies like Vanguard and State Street. Vanguard has the low cost, no load, ETFs and mutual funds. State Street also, they have those options. Fidelity,
yeah.
We have Schwab. That's they have headquarters in Austin. They're also provide a variety of these kinds of things, and on their websites, it's become a lot easier to navigate those things, even if you don't have a lot of experience. You can go into those websites, they have an investment. They'll basically have an investment locator kind of thing, and they'll ask you questions and funnel you down to things that might work for you. And that's actually great if you're just getting into it and maybe you think, hey, I'm only doing $250 a month. How much time is somebody going to spend with me? You really don't need a CFP, to help you with that. But those websites, people on the phone that help you from those companies are really very useful. And
I
they're very
know.
easy and they're low cost. And that's the main idea is you really want to keep those costs low, because that's ultimately what affects your investment performance.
Now, I tell people all the time, fees kill return, right? If you're hoping to make 8% a year over a 10-year period and you're paying somebody 7%,
That's right.
yeah, that's not good. Real quick, any websites that you like, Investopedia or anything like that for people to get?
Investopedia is great. And I find a lot of people that start to get into investment that, it can be very overwhelming. Then we have this term in the business, we're all students of the business. I've been at it for 35, more years. But, we're still learning. And the Investopedia is very nice. It gives you those terms. It sort of explains what the terms are and, what the pluses, for or minuses or that kind of thing. I think the websites for Schwab and for Fidelity and for Vanguard in particular are really very useful. They give you the information really well broken out. Now, if you're an individual,
I'm going to go ahead and cut you right there because
Yeah.
we're running up against it. But I will say, I think I agree. I think those are all great sites out there on the internet. And just so you know, we are not being paid to say that. So
that's right.
Just our personal opinions. Christian, I want to thank you for coming in and joining us today. And I want to thank everybody out there for joining us today on the topic. If you enjoy the show, follow us on Facebook and on YouTube at Houston Community College District. To listen to the topic and more HCC TV programming, visit hccs.edu/podcasts. For everyone here at the topic on HCC TV, I'm Daniel Scholl.
I'm a first-generation Filipino American. You don't always feel you're a part of the country you live in. It's this weird middle space sometimes that you have to live inside of. But when you meet others that are also living in that space, you'll learn to know that it's its own unique space too.